Interest rates are starting to come down, and a lot of investors are thinking it's time to start loading up their portfolios with high yield dividend stocks, lock in those dividend yields, make sure they're prepared to generate the income and the returns that they want to get going forward. I'm Jason Hall. This is Investing Unscripted, and we're going to talk about a couple of high yield dividend stocks that might be on your radar: Brookfield Renewable and NextEra Energy Partners. One has a high yield above 5%. One has a double-digit yield approaching 15%. We're going to take a look at both, talk about which one you might want to consider depending on your situation, and why there's one that I think is the more predictable winner. Before we get into the details of Brookfield Renewable and NextEra Energy Partners, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you need to check out our special link. Go to fool.com/unscripted. Again, go to fool.com/unscripted. You can get access to the Motley Fool's 10 best stocks to buy right now. Go check it out. Okay, let's start right here with the thing that might have both of these stocks on your radar. Brookfield Renewable, 5.3% yield. It's a pretty good yield. It's a high yield. It's higher than you're getting for treasuries, 10-year treasuries. There's some corporate debt out there you can get that pays a higher yield. But the thing that's attractive about Brookfield Renewable, of course, is this is a company that's growing its cash flows over time. And its dividend, its distribution is actually growing on a per share basis. Let's see you do that with a bond. You can't, right? You get what you get. You can't get upset. Now, what about NextEra Energy Partners? 14% yield. That dwarfs Brookfield Renewable, makes it look like a terrible, paltry little yield. Just for some real context here, let's compare it to the S&P 500. The average yield for the S&P 500 is 1.32%. So that really puts it into context how good Brookfield Renewable's yield is, and then how otherworldly NextEra Energy Partners' yield is. Now, here's the thing. This is important. We're going to start here with this. The next thing we're going to talk about is catching a yield trap. What is the risk? Why is one yielding so much higher than the other? So the core thing that we need to talk about is that they're two really similar businesses in terms of what they do. Now, why they exist is a different story, but Brookfield Renewable and NextEra Energy Partners are both yieldcos. What that means is they're companies that they own and invest in largely renewable energy assets, things like solar, wind farms, the underlying assets that connect those, the transmission that connects those assets to the grid. In the case of Brookfield Renewable, it's a little more diversified. It owns a stake in Westinghouse, the company that makes nuclear reactors. It owns some hydroelectric production. So it's got a little more diversified base of assets that it owns beyond just wind and solar. NextEra Energy is almost entirely wind and solar. They have some natural gas transmission that they're actually largely divesting to help pay down debt. So they're really similar businesses in terms of kind of what they do and the purpose that they serve. Now, here's a really important thing. When you have two companies that basically serve in the same industry that are yielding wildly different dividend yields, there's usually a really important reason. And often for that highest yield stock, it's not a particularly good one. And that's the case right now with NextEra Energy Partners. So this gets back to the purpose they serve, why they exist for the controlling entities. And in the case of Brookfield Renewable versus NextEra Energy Partners, they have two very different parent companies that control them, that use them for different things. Now, we'll start with Brookfield Renewable. Brookfield Renewable exists as an operating entity and also a co-investment partner for Brookfield Asset Management and Brookfield Corporation. Brookfield Asset Management is a large alternative asset manager trying to find assets that are not correlated to the stock market, or they do a certain thing like generate steady cash flows over very long periods of time. Now, again, Brookfield Renewable's core assets, a solar farm, for example, or a wind farm, it's the same thing. If you build a utility scale project, you're going to sign contracts to sell the power from that project on very long periods of time. You have rates, the rates go up over time based on inflation and other factors. So you have a massive amount of predictability. You finance that project at a set cost, and then you lock in the cash flows from the production from that facility. You have a very predictable stream of income. It's a great uncorrelated asset to invest in. Now, for Brookfield Asset Management, again, they're really good at investing the capital. They gather the capital in, lock it up under these long-term agreements, but they need an entity that can also operate those things and then is an expert in buying and acquiring and finding those assets and developing them over time. And that's the purpose that Brookfield Renewable exists as an organization. It also gets to be a co-investment partner, investing its own capital along with the capital from Brookfield Asset Management's funds that are co-investing in a lot of its vehicle. Of course, its parent company, Brookfield Corporation, is the parent company of both of those. Brookfield Corporation is a large equity investor in Brookfield Renewable. So the point is, it might sound complicated, but it exists to operate those assets and to be a co-investment vehicle in them as well. We move over to NextEra Energy Partners. It's a little bit of a different story. NextEra Energy Partners was created as a way for NextEra Energy, which is one of the largest utilities in the United States. Florida Power and Light, for example, is its largest subsidiary. And that's basically the electric provider for the vast majority of Florida, the state of Florida. So what it has done is use NextEra Energy Partners as a way to deleverage its own balance sheet. What it will do is what they call drop down, which is just kind of corporate speak for selling those utility scale projects to NextEra Energy Partners. NextEra Energy Partners takes them on its balance sheet, operates them, manages them, and NextEra Energy is able to get them off of its balance sheet and kind of deleverage, right? So it's a good partnership for deleveraging. Now, interest rates have skyrocketed, and it's made that purpose far less valuable. As interest rates have gone up, there's been a tremendous amount of concern about the long-term viability of NextEra Energy Partners' dividend. It's had to take on a ton of debt. Every time NextEra Energy would drop down an asset, NextEra Energy Partners would finance that with debt. Problem is, because interest rates have gone up, cost of capital has gotten so high, it makes it more difficult for the math to work to drop assets down. It's getting to the point where the excess cash flows that it generates are getting awful close to not being sufficient to cover all of its financial obligations, including its dividend payments, including paying to service its debt and to fund its operations. The margin is getting thinner and thinner. And of course, it's selling off assets like its natural gas assets to help reduce debt. It's got to reduce debt while also still maintaining enough cash flows to support its obligations. We can talk a little bit about when things have kind of come to a head. I'm going to share a 3-year chart here. You can see right here when the dividend yield skyrocketed for NextEra Energy Partners. And the reason that it skyrocketed is not because they vastly increased their dividend. It's because the stock price absolutely plummeted. So what happened here? This is when NextEra Energy Partners revised some forward guidance about their ability to grow. Basically said that they're not going to be financing a bunch of growth, and they're going to try and grow within their cash flows, expanding existing assets and not acquiring new assets. Needless to say, that was telegraphing to the market some real concerns about the viability of its dividend. Now, an interesting thing has happened along the way. So even from that period where the price got cut, the dividend has still continued to move higher. So what does that mean? In short, the company's been able to hold up its end of the bargain so far. They've still been increasing the dividend. They're trying to thread that needle, addressing their debt concerns, trying to reduce debt, and still continue to pay that dividend. The market right now is saying, I don't believe you. I think the dividend is going to get cut. Put all that together, and what should investors think about doing? It boils down to 2 different things. How important is the security of the dividend? How reliant are you going to be on seeing that dividend come in and continue to grow over the long term? For investors who are looking for predictable dividend growth, trying to minimize risk, I think Brookfield Renewable wins here. Yeah, the yield is much lower, but I think the dividend is far safer. The market obviously sees risk with NextEra Energy Partners dividend. And while NextEra Energy Partners dividend might not be on thin ice, there are certainly some cracks in the ice that investors need to be very aware of. So if you're an investor who's looking for stable, safe dividend, then I think NextEra Energy Partners is the way to go. Over the long term, this has been a market-beating investment between growing the dividend, high single-digit rates, so even double-digit rates in good years. You're going to get dividend growth, and you're going to earn really good returns as they continue to scale up the business. Now, if you're an investor who's maybe thinking about taking on a little more risk, that the market's wrong, NextEra Energy Partners management is going to be proven outright that they're going to be able to thread that needle on addressing their balance sheet, maintain the dividend, maybe even keep growing it, then NextEra Energy Partners could be a massive winner, because at some point, if they prove this out and the balance sheet does get stronger, well, guess what? investors are going to come back to it. Again, the math's not favorable. If you look at their reported financials and their quarterly filings, there's definitely reason that the market is concerned. But if they manage to pull it off, the stock is going to go up a lot because the market's going to readjust. It's going to value the stock more appropriately. The yield's going to come down, but not because they had to cut the dividend, but because the stock price has come up, and investors are going to get rewarded for taking that risk and navigating through that environment and profiting as a result. Where do you live on the risk profile? I think that's what you're going to have to consider before you decide which stock to buy. For me, I think Brookfield Renewable is certainly the safer way to go. It's the one that I have in my portfolio.